Dear students, in this session we will introduce the theory of cause. But before beginning a discussion of the theory of cause, we first clarify some of the issues associated with the definition of cost. Specifically, we distinguish between two types of cost: accounting cost and economic cost. We distinguish between accounting cost and economic cost. Accounting view of cost stresses on out-of-pocket expenses, historical costs, depreciation, and other bookkeeping entries. So, accountants' view of cost stresses out-of-pocket expenses, historical costs, depreciation charges, and other bookkeeping entries. An economist's definition of cost is different from an accountant's definition of cost. For an economist, the cost of any input is given by the payment necessary to keep that input in its present employment. That is, the cost of any input is given by the payment necessary to keep that resource in its present employment. Stated differently, the economic cost of using an input is what that input is paid in its next best use. What an input is paid in its next best use, we call it opportunity cost. We call it opportunity cost, cost of the next best use. Now, one way of distinguishing between accounting cost and economic cost is to consider the cost of various inputs: labor, capital, cost of various inputs, labor, capital, and entrepreneurial services. Entrepreneurial services in each system from the perspective of an accountant and from the perspective of an economist. Let us first consider the labor cost. We first consider the labor cost. For an accountant and also an economist, both the economist and also the accountant considers the labor cost in the same way. They treat labor cost in the same way. For an accountant, expenditure on labor are current expenses, that is wages paid to the workers So it is part of cost of production. For an economist, labor cost is an explicit cost. And for an economist, labor services are contracted at an hourly wage rate denoted as W. Labor services are contracted at an hourly wage rate, and it is assumed that this is what the labor can earn in its next best alternative. Economists' concept of cost is opportunity cost, and the wages received by the labor is assumed to be same as what the labor will receive in its next best alternative. So the treatment of labor cost is identical in the case of an accountant and also in the case of an economist. Let us consider the second, the capital cost. The capital cost. The cost concepts diverge more in the case of capital services. For an accountant, for calculating the cost of capital, the accountant will consider the historical price of capital. Historical price of capital means the cost of purchasing the capital goods, the cost of purchasing the machinery. And the accountant will use an arbitrary depreciation rule to determine how much of that machine's original price to be included in the current cost. As an example, suppose that a machine is purchased for $100, will be in use for say 5 years. So that means 20% will depreciate every year. So an accountant will consider $20 as the capital cost. $20 as the capital cost included in the current output. So the accountant calculates the historical price and apply an arbitrary depreciation rule to determine how much of that machine's original price is to be included in the current cost. An economist considers the historical price of machine as sunk cost. Historical price of the machine as sunk cost. Sunk cost means a cost which is made and cannot be retrieved, and sunk cost is irrelevant for current output decisions. It has been already paid and cannot be retrieved. Such a cost is sunk cost, so it is not relevant for output decisions. They instead regard the implicit cost of machine to be what someone else has to pay for the use of the machine. So the cost of one machine hour is the rental rate of capital that is considered by the economist, and we denote it by the notation R. As an example, suppose that a tractor is purchased for $1 million. For economists, it is a sunk cost. Then what is the cost of capital to be included in the current output? It is the charge of machine per hour. if you rent this machine, then you have to pay rent for the use of the machine on an hourly basis. And this rent is what is considered as the cost of machine by the economists. And this distinction is not relevant if we assume that a company always use rented machinery. A company always use rented machinery. In that case, the accountant cost and also the economist cost will be one and the same thing. So, this is the rental rate of capital. The third one is the cost of entrepreneurial services. The third distinction, the cost of entrepreneurial services. The owner of the firm is the residual claimant who is entitled to whatever extra revenue or loss after paying other input costs. And for an accountant, this income is what is known as profit, whether this is positive or negative. Profit, whether it is positive or negative. That is, what remains after making payments to capital and labor is the claim of the entrepreneur, and this is considered as profit by an accountant. But when we calculate the remuneration of entrepreneur from the perspective of an economist, the concept is different. An economist will ask whether the entrepreneur encounter opportunity costs, whether the entrepreneur, the owner encounter opportunity costs by working in his firm. Two important opportunity costs are cost associated with working in his own firm and also utilizing his funds for the setting up of the firm. Utilization of the funds for the setting up of the firm. So, these services should be considered as inputs and costs should be imputed to them. Costs should be imputed. They are services and costs should be imputed to these services. As an example, you consider a computer programmer who starts his own business. And what is the cost? If his services are given to another software company, he will get the salaries. So what is the cost of a programmer starting his own or devoting his own time for the firm? That is the lost income from providing his services to another firm. So a part of the accountant's profit is considered as entrepreneurial cost by the economist. So the entire profit received by the entrepreneur is not profit in economics. A part of it is considered as entrepreneurial cost. And economic profit might be less than accounting profits and even negative if the computer programmer's opportunity cost exceeds accounting profits. And a similar argument can be used in the case of funds allotted by the entrepreneur for his own firm. Instead, he could give his funds to some other firm. He will get interest from this. So the opportunity cost is the interest foregone by devoting his own funds for his own enterprise. And even if an accountant reports a positive profit, it is possible that from the economist's perspective, it may be negative, provided that it is not sufficient or it is not equal to the salaries received by the entrepreneur in the next best alternative. It also includes the return on funds allotted for his own firm. Now we define economic cost. Economic cost. Now economic cost of any input is, as we have seen, is the payment required to keep that input in the present employment, or it is the remuneration received by the input in its next best alternative. That is the economic cost. It is different from an accountant's concept of cost. And in our analysis, we make two simplifying assumptions. We assume that there are only two inputs. We assume that there are only two inputs. One is homogeneous labor, measured in hours. The other one is homogeneous capital, measured as machine hours. And entrepreneurial costs are considered as included in capital cost. So when we consider capital cost, entrepreneurial costs are included in it. So the only opportunity cost faced by the owner is the capital that he provides. The only opportunity cost faced by the owner is the capital cost, the capital that owner provides. It means that if you calculate cost from the economist's perspective or accountant's perspective, cost of capital and labor, in it included is the cost of entrepreneurial services will be identical. Then the difference arises if the entrepreneur is using his own capital in his own enterprise. That is the major opportunity cost. Now, inputs are assumed, the second assumption is inputs are assumed to be purchased from the competitive markets. Markets are assumed to be competitive. So, entrepreneurs purchase inputs from competitive markets. That means entrepreneurs can purchase capital and labor from at constant W and constant R. W and R are assumed to be constants. So W and R are parameters in the decisions of a firm, and a firm has nothing to do with W and R. For a firm, these W and R are given and the firm has no choice over this. So cost is denoted as W into L plus R into K. W, wage per hour multiplied by number of units of laborers employed, plus rent per machine hour multiplied by number of units of machine hours used. So this is the cost concept which we use in our cost analysis. And always remember the difference between accounting cost and economic cost. And based on this, we will also make a distinction between accounting profits and economic profits. And economic profits may be equal to or less than accounting profits. And in some cases, even if accounting profit is positive, economic profit can be negative.